All right, let's jump right in, shall we? Welcome to a deep dive into the world of instant funding prop firms. We're going to be looking at this through the lens of the Traders with Edge podcast.
Sounds good.
You've given us quite a stack of notes and articles here. We're going to try to break it all down so you can make the most of this whole instant funding thing. And by the way, speaking of the Traders with Edge, they don't just offer great insights on their podcast. They actually provide funding for traders who up to $500,000.
That's right.
Pretty amazing stuff.
Yeah, this whole instant funding model, it's really revolutionizing how people get into trading. It used to be you had to grind it out for years. At traditional prompt firms, you slowly build up and maybe, just maybe, get a shot at real capital. But now, the barriers to entry are way lower.
Okay, I'm already seeing the appeal here. It's like instant gratification for traders. But I got to ask, what's the catch? There's got to be a downside, right?
Like anything else, there are pros and cons. But the catch, if you want to call it that, is actually a good thing. Risk management.
Okay.
These firms aren't just handing out $500,000 without any safeguards in place. They have strict rules in place, which honestly is in your best interest. It protects you from blowing up your account, and it teaches you discipline.
So it's like having a safety net while you're learning to walk the tightrope. I can definitely see the value in that. Okay, but let's say I'm all in on this instant funding thing. How do I even begin to choose the right firm? They all seem to promise a world.
Yeah, that's where the research comes in. You're smart to be cautious. You need to look beyond the flashy marketing and really dig into the details. Profit splits, drawdown limits, the markets they offer, their trading platform. These are all critical factors.
Okay, so it's about being a savvy consumer, not just jumping at the first shiny object. I got it. But let's say I found a firm that ticks all the boxes. What happens next? Is it mountains of paperwork? Weeks of waiting?
Not at all. That's the beauty of instant funding. The account setup is usually super streamlined. They've really nailed down that onboarding process. Verify your identity, familiarize yourself with the platform, and bam, you're pretty much ready to roll.
Wow. So from researching firms to live trading could happen in a matter of days. That's mind-blowing.
Okay.
I'm officially intrigued. But before we go any further, let's address the elephant in the room. Risk management. I know you said these firms have rules, but I still get nervous just thinking about potentially losing money.
I hear you, and it's good that you're thinking about that. But remember, risk management isn't about avoiding losses altogether. That's impossible in trading. It's about minimizing those losses and protecting your capital so you can stay in the game for the long haul.
Okay, that makes sense. So where do I even begin with this whole risk management thing?
It all starts with understanding position sizing. This is trading 101. And it's especially critical with a funded account.
Position sizing. I've definitely heard that term thrown around. What does it actually mean in practice?
In simple terms, it's about determining how much of your capital to risk on any single trade. And one of the most common guidelines is
the 1% rule. Okay, that sounds simple enough. But why 1%? Is there like some magical formula behind that number?
it's less about magic and more about giving yourself a buffer. Markets are inherently unpredictable. No matter how good your analysis is, you will have losing trades. The 1% rule helps ensure that even a string of losses.
So it's like an insurance policy. For my trading capital, I can get behind that. But what about those times when I'm feeling super confident about a trade? Can I bend the 1% rule a little?
That's a great question. And it gets to the heart of one of the biggest challenges in trading, managing your emotions. You'll be tempted to go all in on trades you feel really good about, especially when you see other traders boasting about huge wins. But trust me, sticking to your risk management plan, even when it feels boring or overly cautious, is what separates the consistently profitable traders from those who blow up their accounts.
So it's like resisting that urge to order dessert when you're already full. Takes discipline, but it's ultimately better for you in the long run.
Okay, I'm starting to get the big picture here. But let's say I've got my position sizing nailed down, and I'm feeling pretty good about my risk management strategy. What's the next piece of the puzzle?
Before we dive into specific strategies, let's talk about drawdown. This is another concept that new traders often struggle with.
Drawdown? That sounds a bit ominous. What exactly does that mean?
Drawdown is the peak to trough decline in your trading account balance. It's basically how much money you lose during a losing streak. And trust me, every trader experiences drawdown at some point. It's inevitable.
Okay, so it's not a question of if, but when. That's reassuring, or maybe not. But how do I handle drawdown without completely freaking out?
That's where setting clear drawdown limits comes in. Your prop firm will have a maximum drawdown limit. That you can't exceed. If you hit that limit, you're out. But smart traders set personal limits below that threshold. So it's like giving myself some breathing room before I hit the danger zone. That's a smart strategy. How do I actually implement drawdown limits in my trading? Do I just write them down on a sticky note and hope for the best?
There are more effective ways than sticky notes, I promise. Most trading platforms have built-in tools to help you manage drawdown. You can set daily loss limits, for instance. If you hit that limit, you're done trading for the day, no
So
exceptions.
it's like having a financial timeout. I can definitely see the value in that. It forces you to step back, reassess,
Mhm.
and come back with a clear head. But let's be honest, I'm itching to hear about those advanced trading strategies. That can help me crush it in these instant funding
I
challenges.
understand the excitement. But before we get into those strategies, let's break down the core principles that underpin successful trading. Because once you grasp these fundamentals, you'll be in a much better position to apply any strategy effectively.
Okay, back to basics then. Lay it on me. What are these core principles?
First and foremost, we have to talk about market selection. Not all markets are created equal, and choosing the right one for your trading style and risk tolerance is crucial.
So it's not just about picking a random stock or currency pair
Right.
and hoping for the best. There's a method to the madness.
Absolutely. You want to trade markets that align with your strengths, whether that's volatility, liquidity, or specific patterns you've identified.
Okay, so market selection is the first pillar. What's next?
Next up, we have timing. When you enter a trade, can be just as important as what you're trading. You need to learn how to identify high probability setups and enter trades at the optimal moment.
That sounds like a tricky skill to master. Were you talking about reading tea leaves or something?
Not quite, but it does involve developing a keen eye for patterns
Yeah.
and understanding market dynamics. And that's where things get really interesting because there are tons of tools and techniques available to help you analyze markets and identify those sweet spot entry points.
Okay, this is starting to feel like we're getting into the meat of things. Market selection, timing. What's the final piece of this core principles puzzle?
Last but certainly not least, we have execution. This is where the rubber meets the road. You can have the perfect market and the most brilliant entry point, but if you execute the trade poorly, you can still lose money.
So it was not just about having a good plan, but about flawlessly putting that plan into action.
Precisely. Execution involves everything, from using the right order types to managing your emotions during the trade. And let me tell you, even seasoned traders can struggle with execution. It's a constant process of refinement and improvement.
Okay, I'm seeing how all these pieces fit together now. Market selection, timing, execution. It's like a three-legged stool. If one leg is weak, the whole thing collapses.
Exactly. And building a strong foundation in these core principles is what will allow you to succeed, not just in instant funding challenges, but in your trading journey as a whole.
This is all great stuff. And speaking of great stuff, I can't help but bring up the amazing opportunity offered by Traders with Edge. Remember, they could be your ticket to trading with up to $500,000. I don't know about you, but that definitely adds a little extra motivation to master these core principles.
Absolutely. And what's even better is that Traders with Edge provides resources and support to help you do just that. So let's dive into some of the specific tools and techniques they offer to enhance your understanding of market selection, timing, and execution. Okay, let's start with market selection. The Traders with Edge podcast frequently emphasizes focusing on markets that are liquid and volatile. They argued that these markets offer the best opportunities for quick profits, which is essential when you're trying to pass a funding challenge.
Makes sense. You need to be able to get in and out of trades quickly without getting stuck. But how do you actually determine if a market is liquid and volatile enough?
Hmm.
Are there any specific indicators or tools I should be looking at?
There are a few things you can look at. First, check the average daily trading volume for the asset you're considering. A higher volume generally indicates more liquidity, meaning you can buy or sell easily without significantly impacting the price.
Okay, so high volume is good. What about volatility? How do I gauge that?
Volatility can be measured using something called the average true range, or ATR for short. It basically tells you how much an asset's price typically fluctuates over a given period, say a day or a week. The higher the ATR, the more volatile the market.
So a high APR means more opportunity for profit, but also potentially more risk.
Exactly. And that's why the Traders with Edge podcast stresses the importance of aligning your market selection with your risk tolerance. If you're comfortable with big swings, you might go for a high ATR market. But if you prefer a more steady ride, you might opt for something less volatile.
Got it. So finding that balance between opportunity and risk is key. But once I've chosen my market, how do I actually pinpoint those high probability entry points? This whole timing thing sounds a bit like trying to predict the future.
It's not about predicting the future. It's about understanding probabilities and identifying patterns that suggest a potential price move in one direction or another. And one of the tools that the Traders with Edge podcast frequently recommends for this is technical analysis.
Technical analysis, I've heard that term before, but I'm still a bit fuzzy on what it actually entails. Is it all about staring at charts until your eyes bleed?
It does involve looking at charts, but it's not just random squiggly lines. Technical analysis is all about identifying patterns and trends in.
So it's like being a detective searching for clues to solve a financial mystery. I like that analogy. But what kind of patterns should I be looking for?
That depends on your trading style and the time frame you're trading on. The Traders with Edge podcast often talks about things like support and resistance levels, candlestick patterns, and moving averages.
Okay, some of those terms are starting to ring a bell, but could you break them down a bit further for me? I need a little refresher course on Technical Analysis 101.
Sure. Let's start with support and resistance levels. Think of these as price floors and ceilings. Support is a price level, where buying interest tends to outweigh selling pressure, preventing the price from falling further. Resistance is the opposite. It's a price level where selling pressure tends to override buying interest, preventing the price from rising further.
So when the price hits support, it's likely to bounce back up. And when it hits resistance, it's likely to pull back down. It's like a financial trampoline.
That's a good way to think about it. Now, candlestick patterns are visual representations of price action over a specific time period. They can give you clues about the balance of power between buyers and sellers. The Traders with Edge podcast is particularly fond of patterns like engulfing patterns and doji candles, which can signal potential reversals in price trends.
Okay, so candlestick patterns are like little visual stories that the market is telling me. And what about moving averages? Those always seemed a bit mysterious to me.
Moving averages are essentially trend indicators. They smooth out price fluctuations over a specific period, giving you a clearer picture of the overall trend direction. The Traders with Edge podcast often uses moving average crossovers as entry or exit signals.
So when a short-term moving average crosses above a long-term moving average, it could be a buy signal and vice versa.
Exactly. And they also discuss how to use multiple moving averages together to confirm trends and filter out false signals.
This is all making a lot more sense now. I've chosen my market. I'm using technical analysis to identify those high probability setups. And now it's time for the moment of truth, execution. But like you said earlier, this is where even seasoned traders can stumble. What are some common mistakes to avoid? And what are the key principles of good execution?
One of the biggest mistakes traders make is chasing prices. They see a big move happening and jump in without thinking, only to watch the price reverse against them. The Traders with Edge podcast constantly emphasizes the importance of patience and discipline. Wait for your setups to form, confirm your signals, and then enter the trade with confidence.
Okay, so no more FOMO trading. Check. But once I've decided to enter a trade, how do I actually execute it in a way that minimizes my risk and maximizes my potential profit?
That's where things like order types and stop-loss orders come into play. The Traders with Edge podcast often talks about the benefits of using limit orders instead of market orders.
Hold on, I need a quick reminder on the difference between those.
A market order buys or sells at the best available price in the market at that moment. It guarantees that your order will be filled, but you might not get the price you were hoping for, especially in fast-moving markets. A limit order, on the other hand, allows you to set a specific price at which you're willing to buy or sell. It gives you more control over your entry and exit points.
So a limit order is like saying, I'm only willing to buy this stock at $50, no more. And if the price doesn't reach $50, the order won't be filled.
Exactly, and that can be a huge advantage, especially when you're trying to manage your risk.
Got it. Limit orders, patience, discipline. These are all starting to feel like essential tools in my trading arsenal. But what about stop-loss orders? I know those are important, but I'm still a bit fuzzy on how to use them effectively.
Stop-loss orders are your safety net. They automatically close your position if the price moved against you by a certain amount, limiting your potential losses. The Traders with Edge podcast provides a lot of practical guidance on how to set stop-loss orders based on your risk tolerance and the specific market you're trading.
So it's like having an emergency brake on my trade. I set it at a point where I'm comfortable taking a loss. And if things start going south, the stop loss kicks in and protects me from further damage.
That's the idea. And they often discuss the importance of setting stop-loss orders based on technical levels, like support and resistance, rather than arbitrary dollar amounts.
Okay, so using technical analysis to inform my stop-loss placement. That's a great tip. But let's be realistic. Even with all the best planning and risk management in the world, trading can still be a roller coaster of emotions. How do I stay calm and focused when the market's going crazy and my heart is pounding in my chest.
That's where the mental game of trading comes in. And it's something that the Traders with Edge podcast addresses quite frequently. They talk about the importance of developing a trader plan and sticking to it no matter what. Having a clear set of rules removes emotion from the equation and helps you make rational decisions, even.
So it's like having a pre-flight checklist for my trace. I go through all the steps, confirm everything is in order,
Yeah.
and then take off with confidence, knowing that I've done everything I can to prepare for a successful flight.
Exactly. And they also emphasize the importance of managing expectations. You're not going to win every trade, and that's okay. Focus on the process, stick to your plan, and the profits will follow.
This is all incredibly valuable stuff. And speaking of valuable, let's not forget about the incredible opportunity offered by traders with Edge themselves. They're not just a source of information. They're a potential partner in your trading journey. Passing their challenge could unlock up to $500,000 in funding. I don't know about you, but that's a game changer. That definitely adds a little extra motivation to master these skills.
Absolutely. And what's great is that the Traders with Edge podcast often features interviews with successful traders who have gone through their program. These interviews provide real-world insights and inspiration, showing you that it's possible to achieve your trading goals with the right approach and mindset.
I love that they're showcasing real success stories.
Yeah.
It makes the whole thing feel so much more tangible and achievable. Okay, I'm feeling inspired and ready to take my trading to the next level. But before we wrap up, is there anything else that the Traders with Edge podcast emphasizes that we haven't touched on yet? Any final nuggets of wisdom they offer to help traders succeed in this challenging but potentially rewarding world?
One thing they consistently reiterate is the importance of continuous learning and improvement. The markets are constantly evolving, so you can never afford to become complacent.
So it's not just about mastering these skills once, but about constantly refining and adapting them as the market changes. It's like a lifelong apprenticeship, always honing your craft.
Precisely. And the Traders with Edge podcast is a great resource for staying ahead of the curve. They regularly feature guests who share their insights on the latest market trends, trading strategies, and technological advancements.
It's like having a personal coach in your pocket,
Yeah.
constantly guiding and supporting you along your trading journey. Okay, I'm officially a fan. I'm feeling energized and equipped to tackle these instant funding challenges head on. But before we move on, I have to ask you, you've clearly spent a lot of time diving deep into this world. What personally resonates with you the most about the Traders with Edge podcast and their approach?
What I appreciate most is their emphasis on building a solid foundation. In risk management and trading psychology, they understand that these are the keys to long-term success. Regardless of your trading style or market preference, it's like they're saying, sure, the fancy strategies and technical indicators are cool, but if you don't have a solid foundation, you're building a house of cards. But I think that's a message that every trader, regardless of their experience level, needs to hear. It's so refreshing to hear a podcast not just about chasing the next hot stock tip, but about building a sustainable approach to trading. But I'm curious, from all your research and listening, what are some of the more unexpected or surprising insights you've gleaned from the Traders with Edge podcast? Something that maybe even seasoned traders might not be aware of. One thing that really stood out to me was their perspective on backtesting. They don't just advocate for it, they break down the psychology behind why it's so crucial. They argue that backtesting your strategies on historical data isn't just about finding what works, it's about building confidence in your approach. It helps you overcome the fear and doubt that can sabotage your trading.
That's a really interesting point. It's not just about the numbers, it's about the emotional impact of seeing your strategy play out over time. It's like a dress rehearsal for the real performance. But speaking of performance, one thing I've always struggled with is tracking my trades and analyzing my results. Does the Traders with Edge podcast offer any advice on that front?
Absolutely. They're big proponents of keeping a detailed trading journal. They recommend logging, not just your entry and exit points, and profit or loss, but also your thought process behind each trade. What were the signals you saw? What was your emotional state at the time? This kind of introspection can be incredibly valuable in identifying patterns in your trading and pinpointing areas for improvement.
So it's like having a therapist for your trading. You're uncovering those subconscious biases and emotional triggers that might be affecting your decisions. I love that. But let's be honest, even with the best tools and strategies, trading can still feel overwhelming at times. What advice does the Traders with Edge podcast offer for those moments when you just want to throw in the towel?
They often remind listeners that trading is a marathon, not a sprint. There will be ups and downs, winning streaks and losing streaks. The key is to stay focused on the long game, keep learning, and never give up on your goals. They also talk about the importance of finding a trading community or a mentor to connect with. Having a support system can make all the difference when you're facing challenges or feeling discouraged.
That's such a crucial point. Trading can feel isolating at times, so having a tribe of like-minded individuals to share your journey with can be... Okay, as we wrap up this deep dive into the Traders with Edge podcast, I have to ask you, what's your single biggest takeaway from all of this? What's the one piece of advice that you think every aspiring trader should take to heart?
I think the most important message is that success in trading is achievable, but it requires a commitment to continuous learning, relentless self-improvement, and unwavering discipline. It's not about finding some magic formula or get-rich-quick scheme. It's about developing a solid foundation, honing your skills, and embracing the journey with all its challenges and rewards.
That's a powerful message to end on. It's not about overnight riches or instant gratification. It's about putting in the work, embracing the process, and never losing sight of your goals. So to all our listeners out there, keep learning, keep growing, and keep pushing the boundaries of what's possible in the exciting world of trading. And remember, the Traders with Edge podcast is a fantastic resource to support you on your journey. Until next time, happy trading.